I just remember this feeling of this weight going into the office that first day of like, it's up to you now. Like, you got to build something. And that was the shift of what a calling is. And it's just any founder knows, I'm sure you feel the same way and know what that feeling is like. And I remember walking down the street and looking at people down the street and thinking, do they have any idea what it means to feel like I'm feeling right now? And the answer is very few people do. And that's what's just so special about being a founder.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. Gene, thanks so much for joining me for an episode of Money Moves.
Awesome to be here, Neil.
I'm excited to have you on. You've been on so many shows, so many TV appearances throughout your career, and I have some questions I've been dying to ask you. The first one is just about your move into venture capital, right? So when I first encountered you, came to know of you, you were Mr. Apple, always on CNBC, and you left this career covering tech, being in Wall Street, to venture capital. What is the story there? What led to that change?
Well, it came down to team and opportunity. And so I've been doing the sell side analyst job for about 20 years. And you're exactly right. It was a career and I absolutely loved it. I love the people at Piper. I love doing what I was doing. And I especially loved the three people that were on my team with me at the time was for 10, 15 years. And the four of us started talking about really moving from an observatory role to getting on the field and actually starting to make a difference. And part of that, like venture capital, is you are investing in companies. And so you're on the field in some capacity there. But when you start a new business, you also have the unique perspective of what it means to actually grow a business. And so as venture capitalists, I think we've had a unique perspective over the last 8 years, just in terms of not only investing in largely early stage companies. We have a fund that does later stage now, but invest in these early stage companies, but also know what it means to grow a business. And so as I kind of put it all together, I started to do the math, and I'm 53 years old at the time. I'm in my mid 40s. And I was thinking, I probably can do this sell side thing for another 10 years and do it with excellence. But then I'm probably at a point where I would be at a point of retirement. That's like the last thing I want to do. And so I thought, these guys are around me, and it's Andrew, it's Mike, it's Doug, this core team. And I know how important founders are, and they were ready to do it. And so I made that shift from a career to a calling. And it's a very different mindset. I remember the night before we started. So I told Piper that we were going to do this kind of in the middle of the year to give them time to figure out the transition. So we also had time to get our new office space and get ready. So I finished at Piper at the end of the year. And then on January 2nd, kicked off Deepwater. And I just remember this feeling of this weight going into the office that first day of like, it's up to you now. Like, you got to build something. And that was the shift of what a calling is. And it's just any founder knows, I'm sure you feel the same way and know what that feeling is like. And I remember walking down the street and looking at people down the street and thinking, do they have any idea what it means to feel like I'm feeling right now? And the answer is very few people do. And that's what's just so special about being a founder. And so I had the opportunity to turn a career into a calling, and I love what I'm doing.
That's awesome. What was it like going out to raise that first fund? You had a lot of people who knew you personally, given the decades on at Piper Jaffray, but also you had probably a following, right, in terms of people who didn't know you personally but knew you from your work. Was that helpful in fundraising? Did it raise questions because it was such a different type of asset? How did that come out?
I like referring to this as the pressure point. You don't waste any time at knowing what was like kind of the critical things going on. And that's exactly right, is that we had the blessing of Piper, we also had them as the anchor investor, which was really helpful. So our first fund was a $25 million fund. And so they were an anchor investor in that. And that was a nice endorsement that allowed us to raise that fund. It took us about probably a year to close that first fund. And I think that the feedback we generally had was, you did these mega cap companies, and how does that apply to what you're doing in venture? That was I think kind of the rub on some people. But so I would say that from my perspective, we've always been about emerging tech, about identifying like critical alien like founders. And so from my perspective, it was all very similar, but understandably from the world of risk management and how people allocate capital, that this is a very different asset class. And so it turns out, I knew this was going to happen, is that I would look back 8-10 years later and say how little I knew at the time. And of course, it's always the case. And so I think that how that went is, yeah, I'm grateful that we had a good network and we're able to get off the ground. And, that second fund, last year we closed our second fund. It was about $45 million. These are early stage funds. So in my view, they shouldn't be more than at most $100 million, just because of the way the portfolio construction is. And so, that was a nice step up, but, we're able to raise that fund in half the amount of time that it took, because the first fund's in a great place. We got some nice winners in there. And so how I think about it is, there were some times there kind of early on, like, was this really the right move to do? I'm happy to report, just loving it.
That's great to hear. There's no regrets. What can you share about each of the two raises, just in terms of, how many people you had to reach out to in order to get how many meetings, and how many of those ended up converting, just like a rough funnel for both funds?
Both funds, we have about 100 LPs in them. And I think that on the other, the second fund, as I mentioned, is bigger. And so the checks tend to be bigger. I think probably the look to book from perspective of people looking at us was probably 2-to-1. I think there were two people that looked, we had one invest, which felt really good about that. A lot of these were, it's in the broader class of friends and family. None of them were my friends, actually friends and family, but they were just acquaintances that I've known over the years. And so that network was really important to get us off the ground. Forever grateful for them. Our second fund was probably 70% of that, 80% of it was from investors from our first fund. And so as we approach this, that first fund, we're based on the Cambridge data, we're in the top quartile pretty much across the board. So we're in a great place. But for us to get to the point of really breaking through to the family offices and more institutional, we've got, call it 5 or 7 institutional investors in fund one and about 10 in fund two. But for us to really break out and get to more, you kind of need the full stakes in the ground in terms of capital returned on that first fund. And so we're in the top quartile in the capital that we have returned. But for these family offices, they really want to see, it's a 2018 vintage, so we're coming into our 7th year, but they really want to see the fund kind of play itself out. I remember right when we were starting to raise money, I left Piper and we were starting to raise money, and we met with a lot of venture people to get advice. And one of them mentioned that, your first carry check is like 8 years away or something like that. I thought there's no way, like, you're going to get your first carry check before then. We're going to get carry on our first fund. I think it's going to end up being a top 10% fund, top quartile. Still believe we can return. We're on expectations, what we told our LPs initially, 3 to 4x return on their capital X fees. We're on track to do that. But we still haven't taken any carry yet, because the fund hasn't returned all the capital yet. And so we got companies to do that. But I would just kind of remind, like, when you're thinking about it, you just really have to be in this mode of a calling versus a job or a career. If that's what you're after to make some money, probably not the right business for you. If you're after this to build something and just be committed to it at a really intense level and put up with that suffering, commitment to suffering, we would call that, to get to those carry checks, I think it's an awesome place to be.
Yeah. The way you talk about that, I think, is really interesting, in the sense that it's not just a job. You can't just show up, clock in, clock out. You have to really be a lot more dedicated to it.
And then by the way, a lot of people in their careers are super dedicated. And I think, but just put one final point. I think the difference is that when you actually start something, whether it's and we've talked a lot about what we've done at Deepwater, but like this is just representative of what startup companies go through. I mean, they they moonlight, see if something kind of goes, and then they jump. And when you jump, there's no safety net on the jump. And so like that piece is something that's just really I really admire about founders.
I agree 100%. And I think it's really, really hard. What's the cliche? You can't get extraordinary results with ordinary effort. I think the same thing is true about commitment. When you think about that for VCs and being the founder of a VC firm, do you think it's because the market is already fairly efficient? And so it's hard to come in as a new firm, or is there another reason why it needs to be that kind of commitment and not just a job?
Well, I think the world of venture is still largely a club. And so I think it's about establishing yourself into the club. One of the benefits that we had before as an analyst, we'd spend a couple weeks a year going and meeting with venture people. I always loved meeting with the venture people because they always had, I think, the most insight in terms of where the world was going. It was like they were operating on a different clock. I was thinking about how a stock was trading in a given day, and they were thinking about how a business is evolving over a quarter. I think that getting into that club is really important. And I think that's why most, the vast majority of venture funds, underperform. It's mathematically there's an average, but most of them don't. I think it's about getting into the club. It's one of the reasons why I remain optimistic about how AI impacts investing in ventures, because it's still about a club. I think it's less about, like, on the public side, AI is going to be everywhere. There'll be tools to help asset managers. We also have a long only business. It's a nice piece of our business. It's doing well, but we're using more and more AI tools, and we're even experimenting with using machines to pick stocks. It's a bold view. It's the goal is to build the BlackRock of AI investing. It's called Intelligent Alpha. It's run by one of our partners, Doug Clinton. And so, but I would just say is like it's a very different dynamic. Like the public stuff, you got to use these AI tools. It's an information speed game. When it comes to venture, it's about the club. And when you say the club, what does that actually mean? Is you have to recognize that there are some investors that just, this is a lot of pattern recognition around what it takes to be a good founder, around what the cap table looks like to be able to support these companies as they undoubtedly go through some sort of revision of their strategy. And I think that ultimately is that this venture group looks around the table, and it just defines this competitive but cooperative approach to investing. I mean, the leads compete for deals, but then they always want to fill out the syndicate with other venture people. This is venture 101, but that kind of adds support to that. And so very different, much more like relationship based. I just think we're looking at a deal today that we've been following this founders. I don't want to say too much because it's really, really early here, but like we look for these alien founders, but this is just an example about like venture versus public. Like we're watching this team of two, and I'll just say they're below 20 years old, each of them, and they're doing something really unique on X. We've seen their product evolve over the last 3 to 6 months, and we direct message them. I mean, that's one way that is pretty unique. And obviously the calls we do with other venture people for deal flows is super important, but you kind of got to be creative to find those alien founders.
I think that's very true. A lot of folks just kind of fish in the same water and end up with similar results. And there's in some ways a positive selection bias, in other ways a negative selection bias, and something that's been talked about for, I think, my entire career in venture. Even before that, people were talking about this. Let's talk about meeting with founders. So you meet with founders. You've been doing it for almost a decade now. What do you think separates an alien founder, as you say, from a normal founder?
There are really 3 attributes to it. One is a comfortable level of an insight. So if something is just like, obviously this should be done, this is a great business, it's probably not a good fit for us. We want somebody who's kind of going beyond the obvious and thinking about something that's beyond that. So an uncomfortable level of insight. The second is an uncomfortable level to suffer. We talked about that dynamic of that each of these businesses, it's rare that the business that you're investing in, this is why we put so much weight in the founders. It's rare that the business that you're investing in, the business model is going to be the same one. The ones that survive, half of them aren't going to make it, half of them are zombies, and a quarter of them make it. But the ones that survive, their business plan is model is very different than where it was when you invested. And so having that ability to be committed to this through some sort of a transition, I think is really important. And the third is an uncomfortable level of ability to communicate and to do it concisely. And so we book 20-minute meetings, and the expectation is that they're 20 minutes. And the expectation is that the founder can communicate that well and interact with us. And it might seem like it's a very subtle test, but some of them can get to the point and some of them really struggle. It's the classic, the time versus how you make the watch kind of a scenario. And so those are three things that we ultimately look for that kind of initial. And then there's kind of another fun one that we'll do is like, do you believe this person can be a billionaire? Do they have a look and a feel like they can be a billionaire? And it's a pretty rough test, but there are just people in your life where you can look at them and say, like, I could imagine that happening. There's other people where you think there's just no way that's ever going to happen. And so that's kind of the billionaire test is another filter that we look at.
That's an interesting one. I've never heard that before. Can you expand on that a little bit? Like, what does it mean? Just like a way they speak and carry themselves or something?
It's a swagger. It's a little bit of, I don't know, indifference is the right word, but sometimes it's confidence in their vision, but not for the sake of being confident. I think it's somebody who's like, you can tell like people who just somehow how there's little subtle cues you can pick up on like the billionaires. There tend to be something that's a little bit off with them. It sounds kind of goofy, but they're not like, it's not Gene Munster. I would say that. Like, I mean, I would love someday to be a billionaire. I'm not, but like, I'm pretty much like middle of the road and very reasonable and structured in terms of how I think and process, and I keep my cool, and like I just operate probably like a normal human being does. But these alien founders, the ones that are kind of have that billionaire, they've got that edge to them. That so then we have to check that with, and this comes up sometimes 25% of the time, is you find an alien founder and then you start doing background on them and him or her, and it turns out that there's some of that founder, those qualities have kind of blown up with them in the past and they've gotten into some hot water. And so that's, when you're kind of like, okay, we're in the right orbit here. Like we're seeing the right looks. We're looking at the right companies along that. So yeah, you want to identify it, but also you have to have some form of kind of doing background checks on people too.
That's a really good point. As I think about it, the founders who have been the most successful that we've backed have a degree of confidence, not necessarily arrogance, but confidence in their own vision, and they're listening and taking feedback, but they have clarity of vision.
Another like example just around that kind of that swagger piece is we'll sometimes just bring the conversation to something totally off base and not even want to talk about the business. And then it's very common for people when you take them off of business and get them talking about other things, they think they're still on the clock, and we'll kind of re-gear the conversation back to business and talk about things that they do that are signs that they're productive and committed and things like that. But we'll want to, I think of one of our most successful companies, the founder was like a Greek mythology, or I don't know if that's even the right word for it, but knew about all these, like it was almost like a conversation around Dungeons and Dragons. And I was like, I could just tell, like just see his mind work and understand like this person, it just is really deep, can go deep in a lot of different areas. And so that's something else we just try to encourage is see, like, just tell me something really passionate that you think you have like an outsized knowledge base to it. Could be anything. Could be gaming related. It could be theology related. It could be lumberjacking, whatever it is. We just want to know that they have this like well-rounded and ability to go deep in multiple levels.
How do you think about the sort of static versus dynamic nature of a founder, right? So the founder that you meet in the first pitch may not be who they are a year or two from now or 3 years from now, or the cliche is right, like lines, not dots, right? So when you're thinking about these characteristics like communication skills or confidence or these kinds of things that could evolve quite a bit over time in either direction, right? It's not always up and to the right. How do you think about that as another factor or vector to consider?
As I mentioned, they're going to be doing something different, as you just said too, something different over time. The model's going to look different. And so that's kind of what we're trying to test for with all these questions. How we think about it is it's like it's the most important. And I think like if you're sitting down, my guess is some venture funds, some early stage funds, when they're pitching their LPs, potential LPs are probably talking about like just the importance of like understanding the business and the market and like what the model looks like. And from our end, we would describe it as 90-10 is about the founder. And so how we think about that question is just, we ask the questions, we do these tests, if you will, and we make a call. And I think the reality is on these founders, it's a gut call a lot of times. And the crazy part is, you look at our first fund, 40 companies in it. What we told our LPs is half of them are going to go away, half will be basically return your capital, and the other quarter is going to provide all the upside, which is pretty standard. But each one of those 40 companies, we thought we were investing in these alien founders that could figure it out each time. And so we get it wrong. We got it wrong half the time, I guess. And so I think how we think about that is just like, that's the decision you got to make. And I would just say one other thing to any founder who's listening to is just the importance of those first 2-3 minutes on a call. Hard to describe. Like, I can't give a recipe for what that means. Like, what do you need to do in those first 2 minutes? But I think that people make up their mind relatively quickly, whether they want to hear more or their mind's off someplace else. And so I really think of a pitch think of it as really a 2 or 3 minute pitch, and encourage people just to go off script. Like, tell some story about, why this is your calling, and just to try to shake it up, because we look at so many companies. Every venture fund look to books of 1 or 2%, something like that. You're looking at more than 1,000 companies a year. And so it's, you just got to find ways in those first 1 to 2 minutes to break through the noise. But that's the stuff we look for, the people who can break through the noise. And then we build some sort of confidence that they can do that pivot whenever that ultimately comes.
I think that's very true. The way I've heard it said is, you're looking at the team, the market, the product, and the product's very likely to change. The team's probably not going to change. So index in that order of importance, understanding what's going to stay the same, what's going to change. You mentioned the look to book on your funnel as well. Can you go into more detail a little bit on that? Like, how many companies do you meet with per year? How many does that turn into investments, just for folks to get an idea, like the rough conversion rate?
So the simple math, the typical fund for our early stage fund, we're making 40 investments over about a 3-year period. So call it about 13 investments per year. And our look to book is ranging between 1 to 2%. And so, I haven't seen the numbers more recently, but it's probably averages between 500 and 1,000 companies per year, typically what we look at. Now, what does it mean to look at a company? If we look at a company, like just go to the website, read about the founders, get a sense about what they're doing, that's not a look. A look would be an inbound, a call, and from one of them, because typically what we do is there are 4 partners that are doing the vetting. After one says okay on that 20-minute call, then I'll go to an hour call where we bring the rest of the partners in, and then usually we'll vote after that. So I think that's just a little bit about how it looks on the look to book. Another piece that we strive for is really just a quick answer and quick capital. And those are small funds, $25 and $40 million fund. We've got a late stage fund, as I mentioned. We got SPVs, we got a public fund, so the firm overall is much bigger. When you have these small funds, one advantage that we can do is move fast. And that's from a founder's perspective, especially early on. Having a bird in hand is really powerful. And so when we think about that, these number of deals, one of the commitments that we have of those 500 or 1,000 plus companies that we'll look at in a year, one of the commitments that we have is we're just going to get a clear answer to you within a few days. And so I think it's just good hygiene. I think venture capitalists do a terrible job of it. I think it's disrespectful to founders. I can't promise that every time we've given that 2 to 3 days, but that's what our goal has been.
I think a classic complaint of founders, and something investors really struggle with. What is something that you think other investors look for that you don't care about or that they over index on?
I think most venture focus on founders. I think that they would probably say that half of our decision is based on the founder, 60% of the decision is based on the founder. It's hard for me to really know what other funds are looking at. I think that, when I do hear like estimates, I would say, like, we don't care. Well, we don't care about estimates. And when we meet with a company and they say, this is what we're going to do next year, it's almost a strike against them, because in the earliest stage, you just have no idea. And to think that you have an idea, I think is, so I would say that any firm that really puts emphasis on what the modeling is of the company, I mean, we want to have a general sense of how you're thinking about it, but like when we see these going from zero revenue to X, X, and X over the next 4 years, it's kind of doesn't line up with how we think about stuff. So to the extent that somebody puts weight in that, I would say they're probably focusing on the wrong things. And the other, like you mentioned, like team and market, like we have a sense of the market. We're deep tech people, and so we got a good understanding of what's going on there. But like total addressable markets are yawners in my, like that slide. It's just painful for me to see because it's always huge. I mean, pick the industry and it's always going to be hundreds of billions or $1 trillion addressable market. And so there's a little bit of an eye roller there. So I think anybody that looks at kind of those two, you just have an intuition like this is generally a big market. And I think that this business model, I kind of like how it's positioned, less capital intense, for example. But those are, I think, some of the things that I would guess. The other piece is occasionally we'll go probably the hardest part about, and this isn't venture capitalists, but when you do seed and pre-seed, you also orbit within an angel community too. Mm-hmm. And sometimes they are well-known angels and sometimes they're not. And I think that's been kind of I think a hard part for me is to see like the difference in deal quality between somebody who's a recreational angel versus like an original gangster type of an angel investor. And I think that like those ones are hard, because the hardest part is when somebody brings deals to you that is in kind of like an angel community and it's just probably not a good fit. And they've already invested their money and they want you to invest. And I would say is like, if you're like a recreational investor in some of these companies, I'd say, I mean, Deepwater would love for you to invest with us, but that's not the point of my comment. I think you just go with a venture capitalist who gets a lot more reps at looking at these companies and can do pattern recognition and kind of have a better sense of what what's north. And so not where your question was going, but just kind of another observation that I've seen is I just wish some of these kind of recreational angel investors would go to somebody else in venture to help them out.
I think that's a really good point. Let's talk about some of your investments, and we don't have to name names, but if you think about your best investment ever, your best investment to date, what can you tell us about how you found it, what made you invest, things like that?
There's a couple of them, and both of them came down from what was amazing founders. One of them was a company, Masterworks, founded by Scott Lynn, and he's a serial entrepreneur, had massive success kind of in the advertising space and has evolved and just had like a true passion around art. And so what they've done is fractionalized blue chip art. So you can own a Picasso, a percentage of a Picasso. Think of this as a very stable asset class that does well. And when markets aren't as good, surprisingly. And the piece there was just knowing Scott for the years that we've known him and just know how, like, he's just defines visionary in my book. And I knew how passionate he was about art. And so I kind of we put those two pieces together. And so that was a great outcome from our perspective. Another is a company, Invisible, and they're moving along. They would like compete with Scale AI, but they basically help the hyperscalers. They basically work for all the hyperscalers to prep and train and with the AI data. They also can help with expert networks to improve expert data too, and train an expert data. And so that's been an example. And I mean, that's the Francis, the founder there, is just like buckle up when you meet with them, because his mind moves really fast. And it's just one of those people you just got to meet to understand it. But
yeah, I met Francis when he started Invisible, like 10 years ago.
No way.
Yeah, and he had Ian Roundtree on his team at the time, who's a friend now at Cantos,
How
if you know
fun is
Ian.
that?
Yeah, yeah.
So
So
you know him. How would you describe him?
Francis is yeah, very sharp, very intense, very clear communicator, back to your point. And his vision back then is what the company is today. It's different, but it's still a very similar vision. And I remember he was telling me about his previous company that he had built and the lessons he had learned and how he was applying them to the new company. And I remember thinking, like, if that's the cycle, if he iterates with that same kind of learning and speed, he's going to figure this out. We ended up not investing, so it was a miss on our part because I know they've done quite well. They're pretty
Well,
large.
we're right in the same orbits. It's fun to know.
Yeah. Let's switch gears to your worst investments. And again, we can leave out names to protect the innocent. But what have you learned from those investments?
Yeah, there's, as I mentioned, half the companies don't work, but within that, there can be ones that are even more painful. And from our perspective, it's okay if founder goes after it and things don't work out for whatever reason. There's dysfunction on the team. But when there is potential fraud on a team, that really stings because I think it speaks to just totally missing getting that alien founder wrong. Maybe you could say there's, this line that Silicon Valley has between fake it till you make it and real, and there gets some blurring there, and we want to make sure that they're on the real side. But there was one investment that I championed, and it did not go well. It was some really ugly stuff in terms of what the founder had taken some money out for himself, and then there was about 20 investors in it. And I remember talking to some of the other venture investors in the company and asking about, like, this just really stings. And she said something to me like, this goes on all the time. Like, don't take it personally. Like, this goes on. I'm still not willing to accept that. I don't think it goes on all the time, but that was one of the stingers. And then conversely, the biggest miss was Hugging Face. And we met with them when they were called Hugging Face, and it was a couple people, and it was basically an AI chat bot. That's why they have the name Hugging Face and the logo, the emoji logo it was basically a chat bot for like social interaction. And I remember debating it, and we did a couple meetings with the founder too, and thinking, like, the team is amazing, but we just don't get it. We don't get how those chatbot businesses. It was just shame on us because we were probably at it for 2 or 3 years before we saw it. And that one just stings. We did end up buying in our later stage fund. We ended up investing in Hugging Face. And so I'm glad that we've returned back to the cap table. Wish we would have made that investment, but like that would have probably changed my life. And that one's a stinger.
I think everyone has one of those. That's the nature of being in the game.
Right.
When you think about both of those, is there something you can take away? I mean, I think, everyone or almost everyone's experienced a case of fraud in one way, shape, or form, or something like that. In some cases, maybe you could have done more diligence or spent more time with the founder. In other cases, maybe there wasn't enough time because the deal was closing, so you had to make a call one way or another. I don't know how much there is to learn from that, but I'm curious if there was a learning you could take away from that or any of the other investments.
Yeah, I think the learning is that and they raised subsequent capital. So we invested initially. There was this allegations, we'll call it, unclear what really happened. They subsequently raised capital. And I think that the lesson, and I'm glad that we didn't have to pay to learn this lesson. But like, if there's any blink, I mean, as soon as you make that investment, I mean, it's a sacred relationship between both ways, between the founders and the investors. And, you go through this speed dating that may be a few days from our perspective, and some for good deals, you got to move fast. And then you start getting into like the marriage of it, and seeing what their work's like, what their communication style looks like, how often. Like, one of our values is to always lead with bad news. It's not our LP's job to excavate bad news. That's like really core to how we operate. And if we don't see those qualities as we're in the learning, getting to know people, the founders, in the months and years after, when subsequent fundraisers come up, that has a huge impact on, again, still on that first round of money that they raise after the initial round. Probably 85% of the decision is still based on the founder. And so I mean, it's cliche, but just trust your gut on things like this and have a team around you too. I think with trusting your gut, it's hard when you're the champion. It's really hard to trust your gut because you're biased. It's the beauty of AI is that it doesn't have emotion. In the case of Deepwater, I'm glad that we have people that stand up to each other, and we have fierce debates. I love them. And I think that's the kind of the secret. So you don't back companies up. Business could be going well. This happens too. Business is going great. Everything's clipping along, but there's something about the founder that we don't like. We'll step out of a subsequent round. And then of course is the business, if in the case of rounds where you need a bridge to kind of stay going, the bar is so much higher to continue to invest. It's rare that we, I don't know what rare is. 25% of the time we'll stay with them when things are breaking down. But having that discipline to know you love this team, but unfortunately it's just not going to work out.
I think it's one of the hardest things, right? When there's an emotional tie, and conviction and confirmation bias to let that go and to change your mind. It's really, really tough. Let's move to our second last segment here of the podcast. We have a newer thing that we've started with folks called asset allocation. And basically the disclaimer here is this is not legal, financial, or tax advice. But Gene, what would be your advice to someone a founder who's had their first exit, or a young investor who's had a good exit and they're, sitting on anywhere from a couple million up to, call it $10 million? How would you advise them to manage their money, considering that they want to keep playing the game? They're not ready to retire, but they want to make smart moves.
I mean, it's the classic. You just want to move to the house, play with the house's money. And so put enough away where you can live comfortably. I mean, even if it's like a $5 million exit, take half of it and put it away in a safe place. And, don't get overconfident too, that it is a lot of times that when you have a successful founder, their second venture is successful too, but a lot of times it's not. And so I would say, be careful. We hear about founders that will take 80% of what they have and roll it into version 2.0 after they've had an exit, and that doesn't work out right. And so when you get an opportunity to have a life-changing event to capitalize on it, and I think that within that mix, like how you should divide it up, I'll leave that to you. I also would just recommend getting like a financial advisor too, and just look at the fees that financial advisors charge at the surface level. Like I'm in the asset allocation business. We have people that do it here, and I can understand why people are fee sensitive and don't want to pay 1% of their assets. But I think when you look at like holistically about just managing for some outcome 10, 20, 30 years down the road, I think it's just well advised. And then the last piece for those founders who have had such a big outcome that they may be my age at 53, or they might be 23 and not have to work again, my advice is do not stop working. And I'm a student of life, and I've been lucky to have a couple mentors that are kind of now in their 70s and 80s and have had successful callings and outcomes. And I think one thing that's clear between those two that they've really made it clear to me is that just the work is good. And I think that it's good for the mind. I think, having something to go for and putting yourself on the line. There's been a lot written about life after the exit. And a lot of times the people that just decide to enjoy, it's not about having a lot of money. I think a lot of satisfaction. For the first 5 years at Deepwater, I did not take a salary. And I would consider myself for those 5 years the most highly compensated person in the world. And so I think that just to keep that in mind, it's not a race to get a number. Again, this falls in the cliche category, but it's just a great reminder, like stay in the game.
Yeah, I think that's very true. I have a number of friends and a number of people publicly also who have said, after an exit, they don't know what to do, and they're just kind of maybe a little depressed, a little stressed because they don't have that same sense of purpose, that same routine that they had
Exactly.
before.
I get goosebumps when you say that because it's true.
Yeah, kudos to the people who've shared that publicly, but I think it's very few, and it's a very common experience. It's hard to understand because you're like, oh, you just had an exit. You should be on cloud nine. Everything's great.
I don't know if this is true or not, but I remember hearing like Neil Armstrong dealt with depression. I think it kind of says a lot.
I can imagine that being hard to believe or understand after the experiences he had. Well, let's move on to the last section here, our lightning round. It's a little bit slower than a lightning round, but we just have some fun questions. An easy one to start, and then a couple of tougher ones after. First one is, what food would you eat if you could only have one food for the rest of your life?
Avocados, love them. About 80% of my caloric intake is through avocados, bananas, protein mix, carrots. Do a smoothie a couple times a day. I keep it simple. I mean, this is a special day here, Neil. Like, I'm not wearing a white shirt and a blue jacket. Like, I got a pretty simple wardrobe and a pretty simple diet. Love avocados.
You look like you're in great shape, so it's working out.
Appreciate that. Yeah, you just keep it simple. That's the key. I think the prices are going to go up pretty soon too, by the way, if I'm not mistaken. But
yeah. I saw Chipotle issued some guidance on that. There was some commentary because all the ingredients are locally sourced except for avocados. So
bummer for me.
Yeah. This is a different question here. What is the hardest lesson you've had to learn in your career?
I think probably the hardest lesson is my style is to be open-minded, to give people a lot of room. And I talk about the 4 other founders at Deepwater, and just that's how I worked with them, give them room, and they've just blossomed and became rock stars and exceed anything that I can think and dream up now. And I think probably the lesson is there are times when you got to be tough on people too. And tough in the sense of holding them accountable. And I think what I've learned too is the right person likes to be held accountable and welcomes the challenge if it's done in a spirit of trying to make you better. And so, I mentioned about leading with bad news is that, the lesson I've learned over the years, at least over the last 8 years, is just the importance within an organization to run to the fire and to talk about it. And you don't need to get upset. You don't need to raise your voice, but just to, in a calm way, just be really open about what your feelings are and challenge people on what some of their feelings are. And I think that's been a hard lesson for me to learn, just that management style. And I think what I've adopted is a question where I'll just say, like, this is what I'm observing. How should I think about it? And just let people, and the good people will immediately say, look, I see where you're coming from. I could have done better here. I can pick up the pace. And the people who just aren't a good fit, it's just such a tell, exactly what they start going into, in a subtle way. They'll kind of divert, like, I was waiting for this from this person, or this wasn't working out, or we didn't have this tool to do that. So I think that, just, going for the hottest part of the fire when things aren't going as like you want them to. I think that's a skill that I've had to learn. That's
a really, really good one. I think it goes against most of our general nature and programming, right?
Yeah, it's hard. Like communication's hard, especially in our world. But like, I think it's a superpower to do that and just to be okay with being uncomfortable in a conversation.
Yeah, getting comfortable being uncomfortable is a theme that's come up quite a bit. This is the second last question here. What's been the best moment of your career so far?
I mean, I'm an old dog, so it goes back a long ways. I think probably the best moment is I think just seeing the team that I've had around me, I've known for so long, excelling. I think probably the best moment from, like, a part of our job is just sticking our neck out. And I think we've had a lot of fun. It's hard to pick one of them. We still spend time in investing in the biggest companies and invest in some of the most profound late stage companies, but probably something around what happened. I mean, this is a really long time ago, but what happened when we started to see what was going on with Apple, and it came off of the .com bust. And analysts were not recommended to make bold stock predictions, bold price targets. And when we upgraded Apple, we came out, the stock was like at $50, $100 price target. And I remember before the meeting, went in there, and one of the director of sales saw the note And he was disappointed that his salespeople had to go out and make a call that we got this big price target out there, because it was discrediting to our research that, these big price targets were back, kind of a thing. And he said something to the effect of, you better go looking for a job. And I guess that's been pretty satisfying.
Yeah, I think you found some good jobs.
Appreciate that.
Well done on that. Last question for you. Who has helped you the most in your career?
I'm not going to say the person's name, but I'm going to describe them. I talked about a couple of those, kind of my advisor committee, my people who mentor me, but one of them he's probably 10 years older than I am, from Texas, grew up a Packers fan, from Minnesota, live in Minnesota, which makes me a Vikings fan. Vikings and Packers don't like each other. Mm-hmm. And I'm going to show you something here, Neil. This is a book here about the greatest story in sports about the Green Bay Packers. And so why on earth are we talking about this book relative to your question? Sure. And it's related to this person who has mentored me and just been a great sounding board and a friend. And I would just say this concept of the Packers embodies why he's had such a big influence on my life. And again, I don't want to give the classic, it's my dad, my mom, my family, like all that stuff, super important. I want to go take in a little bit of a different direction outside of those people. Maybe that's the answer here is, so the Packers are an amazing organization because they just strive for excellence. And even though I compete and think of them as like an enemy when it comes to sports, I've learned to appreciate like what a call to excellence is when you run an organization. And we've made trips to Green Bay. I mean, imagine this, like as a Vikings fan, going trips to Green Bay, going to Vince Lombardi's house, going to the church you would go to before, going to Lambeau, going to different games, and like just getting a sense about like that piece of excellence. And you just have to bring that, like everything you do all day long needs to be tight and crisp right around that excellence, just like the Pack organization. And you just, whether it's a text you're writing, whether it is how our office looks, what people's desk is on their desks, all of that, like that attention to detail, that attention to excellence, he's really instilled that in me. So I'm super grateful for him.
Well, that's a really inspiring place to end the episode. I appreciate you sharing that and giving us a little bit of look into your life and your journey. And thanks for making the time.
Right on. Really enjoyed it. Bye for now.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.